Today's pullback in the market. Stocks posted their second consecutive weekly gain. The S&P 500 up 20% so far this year, more than 60% higher from its March low. That makes it rather tough to be a bear in this market, or does it? Let's ask one well-known bear, David Tice, Chief Portfolio Strategist for bear markets at Federated Investors. David, good afternoon. Good to have you back with us.
Nice to be here, Carol.
So is it tough to be a bear in this market?
Well, it's painful, Carol. It's not unexpected that there can be a rally off the low. There's been a remarkable change in sentiment from bearishness to bullishness. Kevin Duffy, Bill Agner at Baring Asset Management have said that this is the greatest shift that we've seen in the last 30 years. We still are bloodied but unbowed. Frankly, we haven't lost that much money because we've been defensive in this rally, but we still think it's going a lot lower. It's just a matter of when it starts. Is
it just psychology that's behind this move in your view, or don't you think that the fundamentals have been getting maybe less bad and maybe a little bit better here?
Well, certainly things have gotten less bad, and that it remains to be seen if we're really seeing too much positive. And the other thing is, how much is it costing to generate this growth? The Investigator General of TARP came out recently and said the cost to U.S. taxpayers might eventually exceed $23 trillion. That's an awful lot of money to generate a little bit of growth, and it's not really helping employment.
You're talking about all the stimulus and what's obviously...
The stimulus, the backstops, the guarantees, the et cetera.
You know, though, David, in other recessions, I mean, you have to do something to kind of get the economy going. If you can, you lower rates. Now, we've done that. We're down to zero. You know, you have to do stimulus programs. What we went through was unprecedented. So doesn't it make sense we've got to take unprecedented moves to kind of jumpstart the economy, and that once things start to get going, that you should assume things will get back on track?
This is really different, Carol, because the magnitude of the stimulus is just so exorbitant. I mean, it used to be $160 billion stimulus plan was significant. Now we're going tenfold that level. The numbers are so bad for our fiscal state in our economy even before all this stimulus. And frankly, it isn't generating that many jobs. And we think what happened in 2008 was unprecedented, and we essentially broke the system. We lost 20% of consumers' net worth. We shut down the shadow banking system, the structured finance mechanism. That's still not working. Frankly, housing lost 25%. And those really aren't coming back very quickly.
All right, so the idea that it's not different this time around, it is different in your view?
It is different this time because in the past, over the last 20 years, what the Fed did is they cut interest rates, they stimulated the economy. In the words of Bob McTeer, the Dallas Fed governor back in 2002, everything will be all right if we all hold hands and buy a new SUV. That's essentially how we kept it going.
Right.
Now, Americans are so broke, and there's so much damage that's been done. As I said, the structured finance mechanism, this is different.
And we're not done deleveraging, are we?
We're not. The banks still are not lending. We still have, dramatic problems in the financial system. They're not really coming clean with how bad the loans are.
Well, let me ask you, because, someone who's very locked into the Treasury market and what goes on has said to me, and the financials had said, we don't know where the toxic assets have gone. Do you feel like they've been dealt with, or are they still on all of those financial firms' balance sheets?
They haven't really been dealt with. And in fact, now the Federal Reserve owns, a bunch of them,
right,
which is scary in itself.
Right.
But they are still on these bank balance sheets. There's still a lot of foreclosure moratoriums. Recent statistics said there's 7 million homes in the delinquency pipeline.
Right, foreclosures yesterday.
Yes, where they're coming.
All right, so let me ask you. So you talk about S&P 400, and you're saying it will fall below 400 within 18 months. I mean, first of all, why 400?
Well, 400 gets you just slightly below book value on the S&P. We think the book value on the S&P is going to decline further. We believe that analysts...
That's a 60% decline.
Oh, I know.
It's
it's horrible. But you look at the fact that just 5-6 weeks ago, strategists had 0.10 EPS for the S&P of about $45 a share.
Right.
Now the numbers have gone up from analysts. We think they've gone up too high.
They don't make sense based on the fundamentals out there.
Yeah, we don't think this market will bottom until it gets to 6 to 10 times earnings.
All right, so in terms of that move down to 400, it's all these things you've talked about, the deficit and all these things. That's what gets us back to that level.
Yes, and markets always overshoot to the downside, and secular bear markets follow secular bull markets, and we've had a long secular bull. Yes, we had an interruption in 08, 00 to 02. Unfortunately, we haven't gone through enough pain.
All right, you know what I'm going to say to you, is that you've been calling for declines in stocks since we've seen this rally take foot or started back in March. I mean, if folks followed you, they would have potentially not made a lot of money or potentially lost money. I mean, what do you say to them?
Well, at Prudent Bear, we haven't lost nearly as much as the market because we've tried to play it defensively. We've retained a short position, and we're reliably short for clients, which is our mandate. However, we've been bearish for 10 years. People have criticized us for a long time for being bearish. Yes, we've lost money in certain years. We've made money 9.5% a year over 10 years.
Right. I know you've got a great long-term track record.
Yes. So we don't try to time it inside Prudent Bear because we feel like it's more important to be a reliable hedge. And we think that this is a Ponzi scheme. And yes, you can invest at the end of a Ponzi scheme and make money, but you might not be able to get out when they turn the lights off. I
mean, similar to what we saw in the internet bubble, in your view? Or even worse?
It's very, very similar. I mean, the valuations don't seem as high relative to eyeballs, et cetera. But when you look at the valuation of this market relative to the fundamentals as they've played out, when you look at the horrible state of financial institutions today, you look at the dollar, you look at the massive fiscal deficit, et cetera, I think we're in worse shape, and the prices are just as high.
All right, so obviously not a good outlook for the market, and obviously not a good outlook for the economy. So, David, does another recession factor into your outlook?
Yes, we think there's another a double dip. We think it could be worse this next time. When the market starts down, that'll be a disillusionment decline. We think a lot of businesses have held on with sales down 20%, earnings down a lot.
So you discard some of the good earnings that we've gotten, whether it's Google, Alcoa, the financials. Do you discard those completely?
Well, most of the earnings are better than estimates. Sales are not coming in that strong relative to last year, and what's occurred is estimates were low, things have gotten less bad. A lot of these companies are benefiting from government programs. Government expenditures is making up about 40% of GDP.
All right, but less bad isn't enough to make you change your tune.
No, it's not.